Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it. And basically, right now, what we are discussing is the types of banks, right? That is the topic we are discussing on. Okay. So basically, we had done three types so far, and the types of banks are known as the first type which we had completed was the commercial banks, right? Second type which we had completed was the regional rural banks. Okay. And the third type which we had completed was the cooperative banks. Okay. So we had discussed these banks in detail. We had seen various phenomena and policies related with them. So I hope that you have revised them properly. Okay. Because in this lecture, we are going to start with another important type of bank. But prior to this, it is very, very essential that you are learning or revising the previous ones before you are coming for the next ones. All right. Because if you are not doing this kind of things, I'm totally sorry for you. You won't be able to grasp the good marks because right now you are cheating with yourself only. Okay. So with this note, let's start this lecture. So students, basically in this lecture, we are going to cover the payment banks. All right. The payments banks are going to be the prime target for us during this session. So I want you all to pay your due attention because the payment banks are very, very important topic right now because they are associated with the digital banking. With the digital banking. Okay. And if you are preparing for a competitive exam, it is very, very, very essential for you to keep yourself updated with your surroundings. And if you are doing so, then you will be aware that right now governments across the world are focusing on the digitalization. It is called the new era of technology. Right? So that's why payments banks becomes more important because they are also connected with this digitalization. It means these are also the part of new era of technology. Got it? So let's start them. First is the general introduction of the payment banks. Okay, like what do you mean by the payment banks? Payment banks are a specialized category of banks in India that were introduced by the Reserve Bank of India to promote financial inclusion, digital payment, and improve access to basic banking services, especially for the unbanked and underbanked population. First thing is that they are of the specialized category. Okay, it means that they are designed for some specific purpose, and by granting the names, we could say that they are basically associated with digitalization and making payments. All right. Second thing is that they were introduced by the Reserve Bank of India. Okay. So if we go by this, then let me tell you, it was November 2014. Okay. When the Reserve Bank of India brought the idea of payment banks. Got it? It is the first timeline. All right. Second timeline was year 2015 when the payment banks were implemented in India by the RBI. All right. So please remember this thing. Payment banks were introduced by the Reserve Bank of India. The idea was brought up by 2014 November and basically implemented in the 2015. Got it? Thereafter, they are basically brought to promote the financial inclusion. How? We will look in this lecture. Digital payments, I have already told you. Improve access to the basic banking services, especially for the unbanked and the underbanked population. All right. It means that the populations who are living in the area, like rural areas, okay, like semi-urban areas, okay, like remote areas. So if the people who are looking in these areas, they generally do not have an access to the banks. Why? There might be no branch of the bank. Okay. There might be no facility to reach the bank. All right. There might be some other kind of condition which is hindering them to reach the banks. All right. So that's why through digitalization, it's tried to become a part of the financial inclusion. Like through digitalization, we could make them unable to use the payment banks for their basic bankings. All right. That's why that idea was promoted a lot. Got it? So I hope that now you have got a little bit idea and the general introduction of the payment banks. It was a specialized category brought up by the Reserve Bank of India in aim, or you can say for promotion of the financial inclusion, digital payment, and improve the access to basic banking services, especially for the unbanked and the underbanked population. All right. Thereafter, if we talk about the introduction and the regulatory part, which we had already covered, but now in a detailed form. Okay. So the payment banks, as I have told you, were introduced in the year of 2015 and the actual time was November 2015. Okay. Under the guidelines for licensing of payment banks. Okay. In actual, even before 2014, the idea was basically introduced in the year of 2011 when the payment banks were first appeared. Okay. But because they were not a part of the traditional banking. Why? I will tell you. Okay. They were not a part of the traditional banking. So that's why on that time, it wasn't possible to include them into the BRA or to regulate them as a BRA. All right. Because BRA stands for the Banking Regulation Act and it is specially designed for regulation of banking sector. All right. Under the BRA, traditional banks and the banks which are performing the traditional banking systems as well their other systems are comes under the BRA. But payment banks were totally new on that time in the year of 2011. So that's why RBI took time for November 2014 when they introduced the banks to the public, and 2015 they issued a detailed guidelines for licensing of the payment banks, or you can say it's a rule book by which the payments banks are to be governed in the Indian territory. All right, to address the need for inclusive and efficient banking services. Okay, so please remember in the year of 2015 when the idea of payment banks were implemented, a book was released by the RBI which known as Guidelines for Licensing of Payment Banks. Guidelines for licensing of payment banks. Okay, please remember this thing. Now, if we move forward, then they operate as a distinct category of banks and are regulated by the Reserve Bank of India under the Banking Regulation Act 1949. Distinct category because, as I have told you, they are not a part of traditional banking. Okay, they are not a part of traditional banking. That's why they could not be treated as a normal bank or as a other banks. That's why they occupied a distinct category, but they are the banks. That's why they comes under the BRA. Okay. And if they comes under the BRA, their regulatory authority will be the Reserve Bank of India. Got it? Payment banks are distinct from traditional commercial banks and are not permitted to engage in all banking activities. All right. They are basically introduced for digitalization and payments. Okay. That's why they are to be separated from the other banks or the traditional banks. Got it? That's why they are not permitted to engage in all banking activities. Got it? That's why they are called the distinct category. They are the banks, but they're not the banks which perform the banking activities. Remember this thing. Okay? Or you can say banks, or you can just write it down. Payment banks are the banks which are not permitted for banking activities in a proper sense. Okay? Payment banks are the banks which are not permitted for banking activities in a proper sense. Got it? Now, let's move forward. If we talk about the objective of the payment banks, okay, the primary objective of a payment banks are to promote financial inclusion by providing a range of basic bankings and the financial services to undeserved and remote areas who do not have access to traditional banks. Okay. So for this kind of population, the payment banks could be used to connect them and then brought them into the sphere of the Indian banking system, or ultimately it will be the part of financial inclusion. All right. Aim to facilitate digital payment and enhance access to the financial services for individuals and small businesses. All right. Like suppose this is a person who owns a shop. All right. He had purchased a thing from city, but he did not have a sufficient money on that time. All right. And he also want to use the payment systems of the traditional banks. But because he do not have a smooth access to those banks, that's why he is not able to use the banking services and he is excluded from the banking sphere. But if he got the access to the bank, which will provide him the payment structure through the digital payments, okay, and also enhances the chances to get the financial services like a personal loan, business loan, credit loan. All right. So in such case, this person would be able to use the bank through the digitalization and he or she will be brought under the banking sphere. Got it? So it is the another objective or aim you can say. Services offered. If we talk about the services which are being offered by the payment bank to their customers. All right. So the first service is the saving accounts. They can open and maintain the saving accounts with a minimum balance limit, typically lower than that of the traditional banks. One thing I would like to make clear here. Payment banks are not the payment apps. Remember this thing. I have seen most people who confuse the payment banks with the payment apps. Like if you are using the GPay, PhonePe, Paytm, so you conclude them as a payment bank. No, my dear, they are not the payment banks. They are the payment apps. All right. They are basically the app, like you have got the scan of someone, like this scanners belong to the HDFC. Okay. And the shopkeeper who had the scanner having the account with the HDFC. All right. You are the person who is a customer. You scan this, and by using any app, and you having the account in SBI. Okay. So by using any app, you are transferring the money from SBI to HDFC. All right. So both the banks, SBI and the HDFCs, are the traditional banks. Okay. And you are using the application interference, you can say. Okay. So please do not confuse so please do not confuse the payment apps with the payment banks. Got it? Because why? If we go with the services offered by the payment banks, we will get more understanding on it. All right. But I have provided you the base, so you can connect it with later. All right. The first thing is the saving accounts. Saving accounts you will not get on the PhonePe, Paytm and Google Pay. Got it? So the saving accounts, they can open and maintain a saving accounts with a maximum balance limit typically lower than that of a traditional banks. So you can say they can allow to hold the deposits. Okay. Because if they are offering the saving account facility to their customer, it means that they are offering their customer to deposit their money with them, right? So they can allow to hold the deposits, but up to the maximum limit of rupees 1 lakh only. Okay. So suppose if this is the XYZ and this is the payment bank, this is the customer who having rupees 2 lakhs saving with him. Okay. So he wants to deposit this money with XYZ. So he could deposit only half of the money. It means maximum deposit could be only rupees 1 lakh. Nothing more or less than it. Got it? So remember this point also. Thereafter, payment and remittance services. Payment banks facilitate electronic fund transfer, including domestic remittances and utility bill payments. Okay. Like this is the customer. This is the bank XYZ. Okay. This person is working in Delhi. His family resides in Jharkhand. Just take an example. All right. So if this person wants to transfer a money, then he could use the payment banks to transfer the money, which we'll call as the remittances. Okay. Instead of it, if he wants to make the payments for various bills like electricity bill, water bill, you can say any place he could visit, the bill he has to pay. Okay. So he could also use this kind of services. All right. Thereafter, ATM and debit cards. They issue ATM and debit cards for cash withdrawals and online or point of sales transaction. It means that if this is the person who is using the XYZ bank, which is the payment banks. Okay. So he could deposit maximum amount rupees lakhs or 1 lakh with the XYZ. Got it? Then XYZ could issue the ATM or debit card to him. Okay. Thereafter, he could use this ATM or debit card for shopping for various places up to the amount he had deposited with the payment bank. Okay. So we can say payment banks could also issue the ATM and the debit cards to the customer. Thereafter, mobile and the internet banking. Payment banks encourage digital banking through mobile apps and internet banking platforms. Okay. Because the main aim behind establishing them was the digitalization, financial inclusion. Okay. So if the payment banks are not able to provide the internet and the mobile banking services, then there is no point left behind their establishment, because they had established with the specific purpose, right? So that's why it is the essential services they are offering to the customer. It means payment banks encourage digital banking through mobile apps and the internet banking platforms. Got it? Thereafter, the services offered. Third-party services. They can sell insurance and the mutual fund products, offering customers additional financial services. It means that besides the basic banking like making payments, beside basics banking, okay, the payment bank could collaborate with third party also. Suppose this is the payment bank XYZ, okay, and this is the third party ABC. The ABC is offering insurance and other products. All right. So the payment bank could promote it in front of its customer. Okay. This is called the third party services. Or you can say if the customer wants to take the insurance, then he could reach the XYZ and the XYZ will direct him to the ABC, which is the company selling the insurance. Okay. So third party services also offered by the payment banks. Thereafter, if we talk about the limitations, there payment banks are not allowed to engage in lending activities, which means they cannot provide loans or credit facilities like the traditional banks. All right. However, payment banks allowed to accept deposits, but they are not allowed to grant loans. Okay, it means the customer of the payment banks could deposit their excess amount like the savings, but they could not take a loan from it because the payment banks are not allowed to provide the loans. Got it? So remember this thing. It is the first limitation that they are not allowed in the lending activities. Okay. Second, they cannot accept fixed deposit with longer tenures and do not offer credit cards. Okay. So the ATM cards they are offering are basically the debit cards. Okay. It means that you could only withdraw the amount, the much you had deposited with the bank. Suppose you had deposited rupees 80,000. So you could only withdraw the rupees 80,000, nothing more than it. All right. So it means that the credit cards are not allowed by the payment banks. Second point is that, however, they are allowed to open the saving accounts, but they are not allowed to open the fixed deposit for longer duration. Okay. Like, for example, the traditional banks could offer the fixed deposit from 7 days to 10 years. Okay. But the payment banks are generally not allowed for such kind of thing. Okay. The maximum balance allowed in a customer saving account is subjected to the regulatory limits. It means that payment banks have to check out that they are following the acceptance regulatory or regulations, you can say. It means that they could not accept more than 1 lakh rupees in their saving account from the customer. All right. Thereafter, if we talk about the capital requirement, like as we know, if we want to start something, we need a initial payment or investment. Got it? Initial payment or investment. Similar things happens with the payment banks. All right. Even with, I think that we had discussed it in the previous lectures. Like if we talk about the private banks. So I had told you the private banks are required to maintain rupees 5 billion, right? Whereas scheduled banks only required to maintain rupees 5 lakhs for the operations or initial capital, you can say. Okay. So if we go by the capital requirements, to obtain a license to operate as a payment bank, applicants must meet the RBI's prescribed payment minimum capital requirement. Like if someone wants to open the payment bank, he or she is liable to get the permission from the Reserve Bank of India after fulfilling the minimum capital requirement condition. Okay, so let's have a look on it. The minimum paid up equity capital for opening a payment bank in India is rupees 100 crores. Okay, it was set up by the Reserve Bank of India in 2015. It means that if this is Mr. X and Mr. Y, right? Mr. X or Mr. Y, they wants to open a bank or the payment bank. It means that they must have a minimum reserve for rupees 100 crores. Got it? So minimum amount should be rupees 100 crores for opening of the payment banks. Okay. The promoters are basically the founders or the people who are opening the bank. Okay. Promoters of a payment banks is required to contribute at least 40% of the paid up equity capital for the first 5 years of operation. It means that if they are contributing rupees 100 crores for opening of the payment banks, okay, it doesn't matter whether they had borrowed this money, they had taken up the loan, whatever they had done. Okay, at least 40% of this. It means at least rupees 40 crores must be submitted by the founders, X or Y. Okay. And even after some time, when the payment banks will issue the shares in the market or try to invite the more investors in the bank, if this thing happen, even in such a time, at least for first 5 years, promoters' shares must be 40%. Okay. It means if the bank was established in 2011, so from 2011 to 2016, doesn't matter external members come or not, the promoters means Mr. X and Mr. Y must hold at least 40 crores or the 40% of the total paid up capital in the bank. If they are failing to do so, then the Reserve Bank of India may take the action against them. Okay, remember, at least 40% of the capital should be lies with the founders or the promoters for at least first 5 years. Got it? Thereafter, the remaining 60% of the capital can be raised through external sources such as venture capital or the private equity. Okay, it means that if they are contributing rupees 100 crores, then 40% of it means 40 crores should be invested by the promoters, and the remaining 60 crores could be raised from external borrowings and the private equity or capital venture. Got it? Now, the Reserve Bank of India also set other requirements for payment banks, such as they must be owned and controlled by the Indian entities, means the foreign banks are not allowed. The foreigners are not allowed in order to acquire the ownership of the payment banks. Second, must have a technology-driven approach to the banking because they are focusing on the digitalization. Third, they must focus on serving the needs of the underreserved and the unbanked customer because on focusing on them, the Reserve Bank of India promoted them in the year of 2014 and implemented them in the year of 2015. So if they are not fulfilling this kind of things, it will not be good thing. Okay. Thereafter, they must not offer traditional banking services such as loan or advances. Okay. It means they are designed for the distinct or the specialized thing. So they are not allowed to grant the loans or the advances. Got it? Now, other capital requirements. The RBI guidelines for the payment banks are aimed at promoting the financial inclusion and providing access to the basic banking services to the wider population. Because through the internet or by using the internet, we could reach more and more people. So does the capital banking. So does the digital banking or the payment banking could include more and more people into the banking sphere. Okay. Payment banks have the potential to play a significant role in expanding financial inclusion in India because they could be accessed by the internet, and the internet nowadays present with a large population. Thereafter, that's what we had discussed. Minimum paid up capital must be rupees 100 crores. At least 40% should be stayed with the promoters for the first 5 years, and external funding allowed only up to 60 crores. 60%. Okay. Exceeding the 60% limit, external funding will be denounced by the Reserve Bank of India. All right. Now, if we talk about the ownership, payment banks in India can be owned by a variety of entities, including non-bank financial institutions, NBFI. Okay. NBFI are financial institutions, are not regulated by the Reserve Bank of India as commercial banks. Example include microfinance institutions, housing finance companies, and investment companies. All right. However, they are also focusing on the finances. Okay. Means they are also providing the credit lines, but they are not accepting the deposit. They are not focusing or working on the traditional model. That's why they are comes under the tag of non-bank financial institution. Got it? And if they are non-bank financial institutions, so it means that they are not under the BRA, and that's why they are not governed by the Reserve Bank of India. All right. Corporate entities such as telecom companies, supermarkets, and retail chains can apply to set up payment banks. They can use their existing customer base and infrastructure to provide the banking services. Okay. Like if they want that their customers should pay them or should use their credit lines by using their own company. It means by using their own payment banks. All right. So in such a scenario, they could apply for the license for the establishment of the payment banks. For this, they had to invest rupees 100 crores at least, must keep at least 40% of the share for first 5 years with themselves, and are allowed to raise 60% from external sources. Got it? Thereafter, the joint ventures. Payment banks can be established as joint ventures between two or more entities, allowing for pooled resources and expertise. Suppose if we have the company A and we have the company B. Both of them want to open a payment bank, but somehow company A only having rupees 15 crores. Company B is also having rupees 15 crores only. Okay. Minimum reserve is 100 crores. In such a case, they could contribute together and will reach the amount of 100 crores. Okay. So in such a case, two or more entities come together to maintain a prescribed capital, and then they are able to obtain a license. Okay. So this is the case of joint ventures. Like they pooled their resources and expertise together in order to establish their payment banks called XYZ. Got it? Public sector entities. Organizations like the Indian Postal Services and the Small Industries Development Banks can set up payment banks using their extensive network to serve as a broad customer base. Like if the government-owned entities, like the postal services, like the railways, okay, like the airport authority, like the SIDBI, or like any other thing which is involving in the business, but they are owned by the government. All right, so that's why they are the government-owned entities. So they could also apply for the payment banks by fulfilling the requirements. Okay. RBI has set certain restrictions on the ownership, ensure independence and proper functioning. Like, no single entity can hold more than 49% stake in the payment bank. Even the promoters are allowed to only have 40% stakes for first 5 years. And after the 5 years, if they try to expand their stakes, then they could only hold maximum 49% stake, so that no single owner could be made. Because to become the owner, you must hold 51% or more stake in a company. But right now, you are not allowing to hold more than 14%. It means there could be no single owner. All right. Promoters must have minimum net worth of 25 crores and experience in the financial sector. It means that Mr. X and Mr. Y, who were trying to open their payment banks XYZ, they are required to raise the capital of 100 crores by putting 40 crores by themselves and 60 crores from external funding. Apart from this, the net worth of Mr. X must be 25 crores and for Y also must be 25 crores. Okay, it means not only the capital they are putting in the bank, but also their net worth is being considered while granting the licenses and the ownership to the banks. All right. So remember, the promoters also must have a minimum net worth of 25 crores. Got it? Thereafter, if we talk about the deposit insurance, then deposit insurance in payment banks is an essential aspect of the financial protection for depositors. Safeguards their money up to a certain limit in case of financial difficulties or failure of the payment banks. It means that if someone deposit their money in the payment bank and the payment bank collapse, so in such a cases, how the person will get the amount back. Deposit insurance for payment bank is provided by the DICGC, a statutory body established under the Government of India, like the traditional banks. Okay. DIGC insures all types of deposits held in payment banks, like the same accounts, fixed accounts, recurring deposit, and the foreign currency accounts. Okay. Now, the key features of the deposit insurance in the payment banks. Maximum insurance limit is the 5 lakh rupees, as I have told you in the previous lecture also. Coverage, all deposits, protection against banks failure. Like if the banks fail, what kind of deposit you have made doesn't matter. You will get up to rupees 5 lakhs back from the DIGCG. Okay. Thereafter, significance, protects depositors from losses. Okay. Like the deposit insurance act as a safety net for the depositors, preventing them from bearing the full impact of the payment bank's financial troubles. It means that if the banks fail, you doesn't have to bear the failure's burden. All right. You will get your money back. Enhances financial stability. All right. Deposit insurance contributes to overall financial stability and reduces systematic risk within the payment banking system. Thereafter, promotes saving and the investments. Deposit insurance still confidence in depositors, encouraging them to save and invest their money through payment banks. It means that if the depositor knows that he will get his money back, even if the bank collapses, then he will try to deposit his money in the bank. All right. Strengthens payment banking sector. Deposit insurance foster a robust and secure payment banking environment, attracting more customers and promoting financial inclusion. It means if the customer is satisfied that this money is safe, he will use the services confidently. Okay. Thereafter, how to check deposit insurance coverage. Depositor can check whether their deposits are insured by a DICGC by visiting the DICGC website, contacting their respective payment banks directly. Okay. Now, conclusion. Deposit insurance is a crucial payment banking ecosystem, safeguarding depositors' funds and promoting financial stability, plays vital role in building trust and confidence in the payment banking sector, enabling its growth and the contribution to the financial inclusion. Now, second is the compliance and the monitoring. Critical aspects of the regulatory framework. governing payment banks in India set by the Reserve Bank of India. Okay, it means first is the regulatory guidelines. RBI issues comprehensive regulatory guidelines and operational norms for the payment banks. Guidelines cover licensing, capital requirements, permissible activities, customer services, technology infrastructure, and the security standards. Anti-money laundering compliance. Payment banks must establish robust AML and counter-terrorist financing compliance frameworks. It means that if someone is using the payment banks to make the payments for terrorist financing and for other illegal activities like drug trafficking and other, then it is the responsibility of the payment banks to block such kind of transaction and inform the relevant authority as soon as possible. Okay. Implementation of policies, procedures, and controls to detect the prevent money laundering activities. AML compliance involves customer due diligence, customer identification procedures, transaction monitoring, and reporting of suspicious transaction. It means that if someone is using the payment banks, then the payment bank must be aware that what kind of customer is this. Okay, what is the true identity of the customer, so that in case of any illegal activities, the payment banks could help the authorities to capture that person. Know your customer, KYC norms. KYC is basically a procedure is to be followed by the bank in order to opening the account with the bank, so that the bank could have a total detail about the customer. In case of the adversities, it could be used by the authorities. Okay. Payment banks must implement KYC procedures for collecting and verifying customer information, including identity and the address proof. Regular updates of customer records are required. It means that if there is any change in the identity and the address proof for the customer, the bank must contact the customer and update it as soon as possible. Okay. Reporting and audits. Payment banks have regular reporting and requirements to the RBI. Submission of audited financial statements, annual compliance reports, and other compliance documents is required. RBI conducts on-site inspections and audits to the assess compliance. It means that as like the traditional banks, the payment banks are also follow all the reporting and audit requirements prescribed by the Reserve Bank of India. Data security and technology standards. Payment banks are expected to maintain high data security because they are using the digitalization, and any breach in the security could leak the data of many customers. Adherence to industry standard security practices and implementation of measures against data breaches, cyber attacks, and fraud. This kind of things are included in this particular scenario. All right. Penalties for non-compliance. What if the bank is not following the orders? RBI can take regulatory action and impose penalties for non-compliance. Penalties includes fines, restrictions on operations, suspension, or revocation of license. Okay. Conclusion. If we draw the conclusion of this particular fact, compliance and monitoring play a significant role in ensuring that banks operate securely and in accordance with the RBI guidelines, contributing to the overall stability and the integrity of the financial system. Thereafter, the last one under the payment banks is the financial inclusion. Introduction of payment banks significantly impacted financial inclusion, enhancing access to the banking services, especially in remote and the undeserved areas through the digitalization or the internet banking. Expanded access to the banking services. Payment banks establish presence in areas where traditional banks are not economically viable. Extended banking services to remote and the rural areas, setting branches and banking outlets for the easier access. Payment banks have been pivotal in promoting digital payments and reducing cash lines. They offer digital payment solutions like mobile banking apps and prepaid debit cards facilitating cashless transactions. That's what they had been promoted. Financial inclusion of the unbanked. Payment banks targeted previously excluded populations who do not have the access to the traditional banks and enable these individuals to open basic saving accounts, facilitating savings and access to the financial benefits. All right. Facilitating government schemes because they are directly used by the customers through the digitalization. So they are instrumental in directing creating government welfare schemes and subsidies to the beneficial accounts. This is also the part of DBT, or we can call it direct benefit transfer. About it, we will have a detailed discussion in the upcoming lecture. All right. Thereafter, enhanced financial literacy. Payment banks engage in the financial literacy programs, educating customers, particularly in the rural areas, about banking and the digital payments. Okay. Cost-effective services, because they are generally not required to open the physical branches. So that's why They offers a low-cost accounts with minimum balance requirements and making banking more accessible. Reduce account maintenance fees and the charges for digital transaction. Microfinance and the small savings. Payment banks facilitate microfinance operations and increase small savings in the rural areas. It means if someone having the amount up to 1 lakh, he could save his account with the payment bank. Provide saving products for small depositors. Alright. So, competition innovation. Yes, it is required. Presence of payment banks has introduced competition in the banking sector, driving improvements and innovations. Customer benefit from more options and enhanced banking services. In conclusion, we can say payment banks plays a vital role of India's financial ecosystem, contributing to financial inclusion and the cashless economy, offer accessible banking options for millions, particularly in the rural and the semi-urban areas. Alright, so students, basically in this lecture, we have completed the payment banks. I hope that you have got the facts and figures properly. In the next lecture, we will start with another important banks. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.